So we are going to look at equities and debt, and our strategy will be based on these two products only. We look at debt mutual funds to invest in. That will be our first product. It is ideal for low risk investors. Debt have generally a lower risk than equity mutual funds. However, they are not risk-free. We are trying to minimize the risk, not eliminate the risk absolutely. As we know, there are various debt mutual funds. There is liquid funds, money market funds, dynamic bond fund, corporate bond fund, gilt fund, credit. Which product do we choose as our first instrument for investing? We are not sure whether that mutual fund is going to give us good returns over a consistent period of time. So we choose the debt funds of funds. Here what happens is that when you put money in this fund, the fund manager goes and selects various debt mutual funds. We leave it to his expertise. That's our first instrument for investing. So I have selected a product which is called as income plus arbitrage debt fund of funds. It's a debt fund of funds. Besides that, it has got an additional feature. It's also an arbitrage fund. So it is a strategy where they trade between equities and derivatives. You get returns of the debt fund, the debt instruments, plus a little bit of additional returns which comes from the arbitrage component. We directly go in the mutual fund and invest in that. So we choose a debt fund of funds because this fund will go and invest in various debt funds. We leave that investment decision in professional hands. Over a long period of time, we have seen debt funds performing well. While debt gives us a lower risk, we have to also look at returns. Second product we are looking at is an equity mutual fund. The only way to lower risk when you are investing in equities is through diversification. If you invest in only one stock, your risks are huge because you are hit by the entire risk that is there in the one stock. So you diversify and do equity investments through a equity mutual fund. There are different baskets of stocks and different types. There's a large cap equity mutual fund, mid cap mutual fund, small cap, thematic. So many types of equity mutual funds are there. As a risk averse investor, we have to choose one of the equity mutual funds. We are going to look at an index fund. Indexes are the reflection of the entire market. And then there are various categories or various sectors, etc., which are covered by these indices. The Nifty and the Sensex are the two popular indices in the country. Like that, there are many other indices which we like Nifty 500, BSE Sensex 500, large cap index, mid cap index, small cap index. Index funds invest in these index stocks only. So Nifty mutual index fund will invest only in 50 stocks of Nifty. A Sensex mutual fund will invest only in the Sensex 30 stocks, so on and so forth. Index funds, they invest only in the index stocks and they try to mimic the returns of the index. So they will give you a returns which is equivalent to the index, close to the index. They are not trying to beat the index. And this kind of investment strategy is called passive investment strategy. That is what the focus of index funds is. So for conservative long-term investors, passive invest can be a better way to invest. Now, which index fund do we go to? So we are looking at a broad-based equity mutual fund. I have chosen for my investment is a 500 stock index. There are a couple of 500 index fund stocks covering a large basket of stock, covering the almost 90% of the market, a very broad-based diversified index. It's a moderately high risk because equity is never risk-free. So over a long period, almost 18% return has been given by this index. Directly, we go to the mutual fund website and invest and go for the growth options. Equity funds will definitely carry some risk, but over a long period of time, this risk will get balanced, will get reduced.